At 5.8% on the 30-year gilt, UK borrowing costs reached a level not seen since May 1998, and the number alone does not explain what moved it there. The pound fell against the dollar, the FTSE 100 reversed sharply, and the Bank of England, already navigating an oil-driven inflation shock, found a second front opening directly beneath it. Tuesday's session began with a familiar weight. The Iran war has been driving energy costs higher for weeks, and the 10-year gilt had already been creeping toward 5.1% in that context. Analysts at Saxo Markets had flagged an upward bias in bond yields as early as the morning open, pointing to the double pressure of rising oil and tightening fiscal headroom. Then the political news flow accelerated. By mid-morning, nearly 80 Labour MPs had called publicly for Keir Starmer's resignation. 4 ministers left their posts before the afternoon. Reports indicated more cabinet members would request a departure timetable. The 30-year gilt yield surged 13 basis points in a single session. The 10-year spiked 10 basis points before partially retreating as some cabinet members rallied around the Prime Minister. Retailers were already under pressure. Barclays data showed UK households cut spending at the fastest rate in 16 months. The British Retail Consortium reported April retail sales falling as uncertainty dented consumer confidence. JD Sports warned of muted growth. High street footfall dropped 10% in its biggest fall since COVID lockdowns. Against that backdrop, gilt selling off hard looks like the market saying something more specific than politics is messy.
Political risk and bond markets do not always move together, but they do when investors cannot price the successor's fiscal policy. That is the condition that changes what a leadership contest costs. Starmer's potential replacements exist on a spectrum that spans from Andy Burnham, a Labour MP described Tuesday as willing to pursue considerably more left-leaning fiscal policy, to figures more acceptable to markets. A Labour backbencher told Times Radio that the markets will have to fall into line with a Burnham agenda. That sentence, spoken political risk and bond markets do not always move together, but they do when investors cannot price the successor's fiscal policy. That is the condition that changes what a leadership contest costs. Starmer's potential replacements exist on a spectrum that spans from Andy Burnham, a Labour MP described Tuesday as willing to pursue considerably more left-leaning fiscal policy, to figures more acceptable to markets. A Labour backbencher told Times Radio that the markets will have to fall into line with a Burnham agenda. That sentence, spoken into a live microphone while gilts were already selling off, was not noise. It was the market's pricing question rendered explicit. How much more spending and with what fiscal rules? Kathleen Brooks at XTB described it directly as a double whammy, the energy price spike pushing yields from one direction, the political crisis pushing from another. The key mechanism is not that markets hate labor, it is that markets price uncertainty, and the spread between the cheapest and most expensive political scenarios widened materially on Tuesday. When the range of outcomes includes a successor who views bond markets as a constraint to override rather than a signal to read, the premium for holding long-dated gilts expands. Jamie Dimon's morning sharpened the channel. JPMorgan's chief said Tuesday he could abandon the £3 billion Canary Wharf headquarters already greenlit after Reeves's budget if the incoming prime minister proves hostile to banks. That is not a minor footnote. It is the world's largest investment bank signaling that the institutional confidence Reeves purchased in November has a conditional shelf life. The 30-year yield does not price today's fiscal reality. It prices the range of fiscal realities that could arrive within the life of a 30-year bond. But here is where the explanation becomes unstable. The gilt move partially reversed in the afternoon as cabinet members publicly backed Starmer. If the sell-off were purely about fiscal trajectory, cabinet loyalty statements would be meaningless. They do not change the budget math. The fact that yields retreated on political reassurance means at least part of the move was about probability of transition, not about what any specific successor would actually do. That distinction matters enormously for what comes next.
The partial afternoon reversal left the 30-year gilt yield above where it opened, and the question the reversal raised is now the central variable. Is Tuesday's high the ceiling of a political shock that fades as Starmer consolidates, or the floor of a new range being established? The historical parallel is close enough to be instructive and different enough to be dangerous. In September 2022, Liz Truss's mini-budget sent UK gilt yields surging and forced a Bank of England emergency intervention within days. The mechanism then was explicit fiscal loosening colliding with a tightening cycle. The current episode begins from a different fiscal posture. Reeves has maintained her rules, but the market is pricing the risk that those rules do not survive a leadership change. The 1998 comparison embedded in the 28-year record is less useful. That period's gilt levels arrived in a different interest rate environment, before the Bank of England had achieved independence, and without an active energy shock as a co-driver. The Bank of England's next scheduled meeting becomes the external checkpoint. Governor Bailey has already signaled concern over stagflation risk, rising energy prices and stalling growth pulling the policy rate in opposite directions. If gilt yields stay elevated, the bank faces a bond market that is effectively tightening financial conditions, while the growth data argues for easing. That conflict does not resolve easily. NatWest, reporting $2 billion profits this week, warned that a stagflation scenario remains a live risk for the UK economy. For continuation of the sell-off, the condition is straightforward. Starmer's position deteriorates further, more ministerial resignations, a formal leadership challenge tabled, and markets are forced to price a near-term transition as base case rather than tail risk. Oil remaining above $100 per barrel removes the bank's room to cut rates as a stabilizer. The 30-year yield above 5.8% on a sustained close would mark a technical break above Tuesday's intraday spike, the level at which the 2022 playbook gets referenced more seriously by institutional desks. For the sell-off to reverse, the threshold is not just Starmer surviving. It is Starmer surviving with enough parliamentary support to signal policy continuity for the remainder of this parliament. A credible whip count showing the rebellion has peaked, combined with an Iran conflict development that pushes oil back below $95, would allow the double whammy to unwind in the same direction it compounded. But a survival that leaves Starmer governing as a lame duck, spending political capital to hold together a fractionist parliamentary party, may keep the uncertainty premium in gilts even without a formal leadership contest. The verification benchmark for the next session is the 10-year gilt yield at the 5.1% level. Tuesday's intraday spike reached that mark before partially retreating. A sustained close above 5.1% on the 10-year would indicate the market has repriced the political risk as structural rather than episodic. Whether Starmer's cabinet holds its public position by end of week is the political input to that number. What would prove the current leaning wrong is a clean, fast consolidation, leadership rebellion collapsing within 48 hours while oil reverses, which would reveal Tuesday's move as a liquidity-amplified spike rather than a genuine repricing of UK political risk. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.